Thank you very much, and good evening, everybody. It's great to be back in Ottawa for our annual meeting with Tradex unit holders. We thank you for entrusting your savings to us in managing the Global Equity Fund for another year, and want to give you an update as to what's been going on and where we think things are right now. So just to remind you, the Tradex Global Equity Fund, we manage this fund by investing in closed-end funds, vehicles which are listed on major stock exchanges around the world and trade at discounts and premiums to their net asset value. And Mike Sugru, the other Mike, is going to get into some more detail about that. But very much our philosophy is value-oriented. We try to buy securities that we think are cheap, both in terms of their underlying exposure, what markets they're exposed to, what sectors they're exposed to, and we also try to buy them at cheap valuations relative to their historical trading range. And so a major part of what we're doing in terms of generating return is to try to buy things when they're trading at wide discounts and sell them when they're trading at narrower discounts. We've been doing this for an extended period of time, 25 years, and have in-depth investment professionals. We have offices in London, outside of Philadelphia, and also Singapore and Dubai, although that's mainly for a frontier market strategy that we manage. And so that just gives you a flavor. With that, we have my colleague Michael Sugru here from our London office, who's going to give you some more information about how we manage the portfolio.
Thanks, Mike. Good evening, everyone. So I'm going to go through a little bit on the actual formal process that we, effectively how we go about constructing portfolios. So it's a combination of a top-down strategy where we're looking at markets, and bottom-up where we're focusing on the manager selection, and more importantly, the discount selection of the funds that we can invest into. So stage 1 and 2 primarily is where we're focusing on the macro. We've got 2 independent macro guys in the London office who look at over 100 markets for us across our strategies. And I think it's important to mention here that the process is the same for whichever strategy that we are running. It's got this top-down element from the macro perspective and then focusing on the discount value. So stage 1 and 2, they independently rate the country components of the index of the MSCI World, and looking at 13 key criteria, they effectively overweight or underweight the different country components. That might be to the extent of 1.2 times the US or 0.7 times to a market if they're less favourable on it. But as I say, the most important part for us here is stage 3, where we're looking at the value and the discounts and those discount ranges that Mike mentioned, and really trying to tilt the portfolio as best we can to the cheapest entry point to gain exposure to the markets that our macro team like. And this is all really risk reduction. We're not looking to add a huge element from a market perspective here. Obviously, from an international and global standpoint, we find that companies listed on developed exchanges, like in London, are very much global by nature anyway. Or in Germany, you can use BMW as an example. BMW isn't so much geared to the German economy, but very much what is going on globally. As I say, the main part of our process is taking advantage of discount volatility, and this slide here shows the drivers of the closed-end fund inefficiency and really the element of how we go about finding that anomaly in the market. On the right-hand side, we have the discount-sensitive actors in the market, which we include ourselves in, the value investors, the institutional side of things. Sorry, what have I done?
Can we get it back for you? There you go.
Sorry about that. And that side of the market, the value investors represents around 20 billion Canadian dollars. On the left-hand side is more the insensitive actors. and in that, the universe is around about 600 billion. So you've got 600 billion in closed-end funds that we're looking to invest in, but there's a very small component who are looking at this from a value perspective. On the left-hand side, you have things like the unit investment trust that you get in the US, where a fund will be built for a 3-year term, a portfolio will be constructed of closed-end funds, and that portfolio will remain the same for the tenure of the fund's life, for the 3 years, irrespective of the value in funds. So when the portfolio is constructed, they may do something similar to us, where they're constructing that portfolio to be tilted towards value, but closed-end funds and the discounts that the closed-end funds trade at can change significantly over time. So one fund in the unitised investment trust may have started its life on a 10% discount, but by 18 months in could be trading at a 5 or 6% premium. And they continue to buy that fund irregardless as fund flows come in. And we're on the other side of that trade, being able to trade the discount ranges that the funds trade at. I'm just going to go into a couple of examples of how we trade. The first one of which is Fidelity European Values. It's a fund that we've held within your fund. We have held it on and off for quite an extended period of time. It's managed by Fidelity, a very reputable asset manager. It gives you exposure to the European ex-UK market, and it's got very consistent long-term performance. The chart at the top on the left-hand side shows you the price of the fund and the NAV of the performance of the fund against its benchmark. The NAV is the yellow line and the index is the red line. So you can see over, I think this chart is over 5 years, that long-term consistent outperformance. The bottom chart is actually the discount that fund trades at, and it's been as wide as a 14 or 15% discount and as narrow as a 2. And through the 5-year period, you can see that discount level changes over time. So depending on those actors that we're talking about, you're getting the discount volatility. There's some black dots on here, which hopefully you can see. You might see them better on the handout. But there's black dots and red dots. The black dots shows you places where we have purchased the fund at the level of discount, and the red dot is where we've actually sold. So what we're looking to do is gain exposure to the European ex-UK exposure that the manager is offering us, hopefully adding a little bit of alpha along the way. And we buy that at a wide discount, and when that discount narrows by 5 or 6%, we then sell it. So actually the exposure that we're able to give you is a European ex-UK exposure plus on 5 or 6% from the discount contracting. This fund's also slightly different in that it's got a biannual continuation vote. And what that means is that every 2 years, shareholders are given the opportunity to vote at an AGM as to whether the fund should continue. And if the shareholders voted that they decided they didn't want it to continue, effectively, one way or another, they would get their money back at net asset value. So when this fund trades out to a 13 or 14% discount, and shareholders are unhappy because they've actually lost some money or the discount they consider to be too wide, they've got the opportunity to vote to get that money returned to them at net asset value and capture the 14% that the discount is widened to. The next example is JP Morgan Japanese Investment Trust. Again, very similar to Fidelity European Values. This fund is managed by Nicholas Wendling, who actually is in Tokyo. We've got quite a few funds in our universe that offer Japanese exposure. We like this one because he's got boots on the ground. He's got the market intelligence, and we feel that over the longer term, he's going to add alpha in his performance. But again, the bottom chart, the discount you can see is very volatile. It's been out as over a 16% discount and as narrow as a 3 or 4% discount. And all the time we're looking to buy a wide level of discount and sell it when the discount narrows. And what we'll do there to maintain our Japanese exposure is switch into one of the other Japanese funds that is trading at the wider end of their range. The last couple of years has been a difficult market environment for us. If you're familiar with closed-end funds, there's been, obviously markets have been a bit volatile and fund flows have dictated that discounts have actually generally widened in our universe. We've seen probably around 300 to 400 basis points of widening across the equity funds that invest in in closed-end funds. In the closed-end funds that invest in equities, I should say. And we've been trying to tilt the portfolio towards the cheaper end of that value. We're always going to look for the fund that's trading at the wider end of the discount. So with that in mind, there's been this headwind for us really with the general discount widening, and that's come through in the performance numbers, unfortunately, in the last year or so. But since inception, you can see in that middle section, we've added around 250 basis points of outperformance over the index since inception. We normally look to add around 50% of our performance from the discount volatility and discount trading, and 25% of performance from manager selection, and 25% from country selection. This next chart is a size-weighted average discount of the portfolio. So it takes every discount of every fund that we hold and size weights it from your portfolio and gives you the average. And you can see that general widening trend at the beginning of the year where the discounts got out from 12 to 15%. We also obviously are trading around discounts, and the contraction that we've seen more recently is as we've exited a private equity position, which was trading at a very wide discount of around 25%, but we'd actually bought into that at a much wider level. So it was an area that we liked, private equity. The performance of the manager did very well. We got the outperformance over the market, but then we also captured that additional discount contraction and decided it was time to sell the position. So that's why you're seeing that sharp re-rating in the discount towards the end of the period. Just to go into a few of the performance drivers over the year. Obviously the detractors, the negative discount trend has been something that has affected us, as I say, particularly evident in the US closed-end funds towards the fourth quarter last year. You have a phenomenon that is tax loss selling in the US, and that really did widen discounts in the US equity closed-end funds. It started much sooner in the year with the fixed income funds in the US, but it really came through towards the end of the year. Now in the UK this year, the first quarter, our least friendly name really for something, but Brexit. The Brexit fears has really affected the way that the UK closed-end funds have been traded. And we've seen significant widening in the UK funds. But that's not just in the funds that are offering UK equity exposure, it's in the funds that are listed in London who are also offering you exposure in Europe and other parts of the world. There's just been fund flows coming out of closed-end funds, or fund flows coming out of those markets, which has affected the closed-end funds also. We've had some issues in regards to the funds that we've invested into for the US equity funds. The fund managers have struggled to keep up with the market, the S&P, and that's detracted from some performance as well. Exposure to the energy markets, we've had exposure via some of the MLPs which have been trading at wide discounts, but obviously with the energy markets not doing particularly well, that's affected performance overall as well. And also we've had an allocation to emerging markets, which is out of index for this fund. On the positive side of things, our ability to actually trade those discounts, we've been able to add a little bit of alpha and outperformance for the fund. We've participated in some corporate actions. One fund that we hold, Henderson Global Investment, it's a global generalist fund, was trading out at a 12% discount, and the manager recently offered shareholders an opportunity to roll into one of their other funds, which has historically traded at NAV or a premium. So we were able to exit the fund at a 12% discount, we had held the fund at a 12% discount, we exited it at NAV, so we had that 12% uplift, and now hold another fund that's trading much closer to NAV, so crystallising that discount. We do also look at sector tilts. We've managed to invest and trade some financial funds and some REITs this year. The NAV performance and the discount contraction has added to performance over the year. And I think at this point I'm going to hand back to Mike to talk a little bit about markets.
Thanks, Mike. So after a couple of good years for global markets where in Canadian dollars they returned around 15%, last year was less positive, and as you can see from this chart, the top top chart, the MSCI World Index, which is the broad benchmark of equity performance, was effectively flat over the year. That masked a lot of volatility within the markets during the course of the year, and also a lot of dispersion among markets. And one of the key issues last year was obviously emerging markets did not have a good year. There was a lot of concerns about the growth in China, and that affected some of the commodity-oriented markets such as Brazil, which also has some political issues that they're dealing with as well. So that was a negative. Also the general slowdown in growth within the global economies also weighed on markets. And really it's just a case of markets had strong gains. Markets generally do not go up in a straight line. It takes time to digest those gains. And so this was kind of more of a consolidation year than a year where good returns were generated. Obviously within that, the US market did eke out a slight outperformance, and that was slightly due to, in Canadian dollar terms anyway, gains in the dollar versus the Canadian currency. Overall, the Canadian currency was relatively weak, and you did see some strength with Japanese yen and also the euro over the course of the year. European equity markets generally were a little on the weaker side, however. So just in terms of global environment and where we see things and what we're thinking about right now, issues of interest, the US election. Hands up who's amazed at what's going on anyway. I was actually given a hard time by one of my colleagues that I only mentioned Donald Trump on this and that there were 4 other candidates involved, but often if you look at TV it doesn't seem that way. You know, who knows what's going on with this US election and how it's all going to turn out. This kind of brings to mind a phrase that a British comedian once said, that there's 2 words that can make him believe any story, no matter how far-fetched, and those are "in America." So obviously Donald Trump's getting a lot of headlines. I think that while there is a possibility that he could be the next president of the largest nation on earth, I don't think it's going to happen. And I think that the Republican Party generally don't think it's going to happen either. But obviously, there's a lot that could happen. We're talking about contested conventions, both on the Republican and Democratic side. And so what I think this generally means is there's going to be more uncertainty. Because the news flow is going to live by the latest polls, and that's just going to create more uncertainty. Markets generally dislike any type of uncertainty, so you know, I think in the end probably Hillary Clinton will be the next president, and once the election's out of the way, that will be an X factor. Obviously, if Donald Trump did get elected, then I think there would be additional volatility after that as well, because I don't think anybody really knows how he might govern. In terms of more factual elements, growth, employment, interest rates. Obviously, it's been an interesting year because the Fed did raise rates towards the end of last year, and initially, you know, it was the most well-signaled interest rate rise ever, and also anticipated. And the markets initially seemed to digest it pretty well, but you know, as over the course of the year, the growth data in the US and the rest of the world, but you know, mainly the US, because the US kind of drives everything, was definitely turning down. And you know, one of the things which is obviously weighing on America and corporations is the strength of the dollar. And really what we think is a problem for the global economy is that in general there is a lack of demand. There is a lack of the credit mechanism generating enough demand and enough growth for the world. So what's going to happen? The US growth data gets a little better, interest rate expectations in the US get a little stronger, the dollar strengthens, it kind of curtails that, and then the cycle repeats. And until we can kind of break that cycle, I think that we're just going to have this kind of ebbing and flowing in the economy and the interest rates cycle. And obviously that affects equity markets. In Europe and Japan, we've had zero interest rate policies adopted, which it's yet to, there hasn't been enough time to see if it's going to be effective. But in general, we think, will people want to pay a bank to have their interest, their deposits there? Probably not. And probably it won't be effective. In Japan, the Abenomics situation or policies that they've been pursuing haven't really worked that well. And Japan has some significant long-term economic challenges. Obviously, the sharp weakness in the oil price has also been hitting the headlines, and also commodities. And again, in theory, that gives a boost because people are spending less on gas and energy, and so therefore they have more disposable income. The thing which is also happening in the US is that they're spending a lot more on healthcare, and that's kind of offsetting some of that benefit, certainly on the consumer side, and potentially one reason why retail sales data in the US has been pretty weak. In Europe, one of the things which is coming up, which we think is going to be interesting to see how it plays out, is obviously the British vote on exiting the European Union. Again, there's no conclusive data in terms of the polls or which way they're going to go, but it does really impact the European Union if the British do decide to leave. I think the knock-on effects could be considerable because if the British are leaving the European Union, then I think other countries will also consider doing the same thing. And finally, China has been obviously weak, as I mentioned. It does seem that that's stabilizing somewhat with some stimulus measures, and so we think that that's probably a net positive going into this year. And particularly may help support some of the Asian markets. What does all this mean? Well, in terms of the monetary policy and what's going on with quantitative easing and the zero interest rates, we're off the map. No one has any guidelines as to how this is all going to work out. So it's like Christopher Columbus sailing off and trying to figure out where he's going. You can be reassured that these are academics with lots of PhDs, but they're also human beings who are prone to making the same kind of behavioral mistakes and being overconfident in their ability to predict complex future events. So expect more volatility. All of these things, the elections, the fact that there really isn't a credit multiplier effect occurring, and you're going to have these, everybody wants a weaker currency, and you can't have everybody getting a weaker currency, so we think it's going to continue to be volatile. One of the areas where potentially there could be a surprise, and we've seen US inflation data turning upwards a little bit. One of the things which I think is interesting is the labour market in the US has been reasonably tight. We've seen the unemployment rate going down, and the question is whether the slack that is in the economy is in the areas where it's needed. There seems to be, anecdotally, what we hear is a lot of companies are struggling to hire skilled employees, and that could result in some price pressure there. And if you see some more inflation coming through, it could put the Fed in a difficult predicament where you don't have that strong growth, but you have some inflationary pressures coming through. We do think deflation will be avoided because I think that the central banks will do whatever they need to do, and that may involve just a printing of money to fund infrastructure projects at some point. Having said all of that, we do think that global equity markets are still probably the better place to be. On the corporate side, there are good stories that in Europe in particular, but also in Japan. So we think that there's especially with bond yields where they are, you're probably going to do better investing in equities. In terms of regional outlook, not too much change. We do still continue to think the US is relatively expensive, hampered by the stronger dollar. You've seen some record profit margins in the US, and so the earnings growth of companies is coming under a little bit of pressure. We've just had a relatively weak earnings season, those that have published. In Europe, the weaker Europe is certainly helping there. They also exponentially benefit from a weaker energy price, and we think on a relative basis they're pretty attractive valuations. UK, the Brexit vote's going to dominate, it's going to be volatile. If they vote to stay in, probably we get a relief rally. If they vote to leave, then it's probably going to be volatile and probably to the downside. Japan has been hampered by the yen's strength, but we do think that the Bank of Japan will be able to reverse that. And we see, while the economy long term is not looking that great, we do see positives on the corporate side, where they're becoming more shareholder friendly. They're doing some share buybacks, and actually earnings results there are actually reasonably positive. Canada and Australia, we continue to believe are hampered by the commodity markets and what may be the knock-on effects of weakness in those areas of the economy. And emerging markets, as I mentioned, driven by China to a large degree. We prefer emerging Asia to the other areas, Latin America and Eastern Europe. Sector tilts, as Mike mentioned, financials we think have been one of the weakest sectors since the beginning of the financial crisis. On a valuation basis, they look pretty attractive. Will they continue to have a discount? Probably, but if we do see some some pressure for interest rates to go up, then typically that's when the financials outperform. And what we've really done in your portfolio is trying to trade that, because you are seeing such volatility in 1 minute treasuries are up at 220, and when they're there, financials tend to have done well. When they go down to 150 as they did earlier this year, that's a great time to buy financials, because generally they've underperformed into that cycle. Healthcare and biotech we continue to like, particularly as they've come off their highs. See a lot of innovation in the biotech sector, and we've got some attractive closed-end funds there. And then energy infrastructure, even though it's beaten up in our performance last year, these are the pipeline companies that are less exposed to the actual energy price. In theory, in terms of their business, their share prices have certainly been affected, but we think that they're trading at pretty attractive valuations as well. So this chart just summarizes our country allocation, overweight to the UK and Eurozone. Again, part of that UK overweight, as I've mentioned, UK market is very diversified in terms of global companies, and so the fact that there's significantly wide discounts within the UK closed-end funds means we can access effectively a portfolio of global companies at some of the widest discounts within our universe, so that's why we have an overweight there. Overweight to the Eurozone as well, and Japan and Scandinavia, underweight to the US, Canada, Australia, and within emerging markets where we do have exposure, we're really trying to take that in emerging markets, Asia. So that's really our presentation. Summary, very much value-oriented approach using closed-end funds, and we just think that it's going to be volatile markets. We wish we could say that it's going to be another stellar year, but I think there'll be times when everything will look rosy in the garden, and other times when the sky is falling. So that's pretty much where we are. Happy to take some questions.